So then, let's get started with the efficient market hypotheses, which is essentially the theory of choice for those that are into passive managed and tracker funds. Certainly, you will be best placed to spend time recognising the connection between EMH, the efficient market hypothesis, and trackers and passive managed funds. A question along the lines of an investor is a firm believer in the efficient market hypotheses, what investments are they likely to select, is going to lead you to an answer that is of a passive managed nature. And we'll look at this and link this together in chapter 6 when we look more closely at the different products that are passive managed. So what's this all about? Well, it's a hypothesis, it's another theory. And it's basically poo-poos the idea of active management in a way. It says that in an efficient market, and efficient means by way of the freedom of information, that it's very, very difficult for you to actually beat the market, for fund managers to find stocks that are undervalued. In fact, the EMH would argue in many cases that there's no such thing as an undervalued stock, that share prices essentially, which are constantly moving, reflect the value of those in the eyes of the public at any given time with the information that's available. So it would argue that in an efficient market such as the UK, where information immediately flows out of firms to the city and prices adjust accordingly, that it's impossible to be in the right place at the right time. So actually, you shouldn't try. You shouldn't pay for fund managers because quite often their positive results will be more down to luck than judgment. So it links to index trackers, to exchange traded funds, exchange traded type investments, passive managed, as we're going to see at a later point. Of course, some active fund managers do very well, and they remain the most popular type of investment. So in reality, the rather idealistic efficient market hypotheses that you can't beat the market sort of approach actually isn't always proven to be true. And many managers will obviously look to combine portfolios in a certain way as to hedge out the risks of the market and their performance. But what I think we do need to understand is that the efficient market hypothesis comes at different levels, and we have weak, semi-strong and strong form efficiencies of the efficient hypotheses. Now, this isn't often tested in the RO2 exam, so we're not going to spend an awful lot of time talking about these, but essentially this is depths of belief. And you work from the weak form, the weaker a degree that you believe in this, to the strong form where you kind of like, this is all that matters really to me in terms of investments. So what does this all mean? Well, in layman's terms, the weak form basically says that the share price that you see at any given time reflects all the past trading history and all the information that's available based on what's gone so far. The semi-strong goes further and says actually no, share prices and the price that they show at the time is not just based on trading volumes and the information of the market, it's also based around all of the publicly known knowledge that a company holds. And I would say that if any of them are probably have a stronger argument, it's the semi-strong really to this. So the share price states all the it reflects all of the publicly available information as well as the trading information of what's gone. The strong form, well, that goes even further and says that actually no, a share price at any given time effectively represents all information, both public and private, that's within firms, as well as the trading information and market information that's gone in the past. Don't spend a lot of time looking at the differences between weak, semi-strong and strong. Whilst it might come up in the exam, it's far from certain.